Today is the 10th of July, and this is a market update for the week of the 10th of July. Top three things today are going to be COVID cases, inflation, and earnings, corporate earnings. And I'll probably sprinkle in a little bit of geopolitics in all of that as well. But let's just talk about COVID for a second. Obviously, we seem to now have a resurgence of COVID on our hands. You know, I talked about this on Wednesday. You can see this chart. This is the current chart of the new cases per day. We had the massive spike, obviously, back in late March, April, and the big wind down sort of into May, and then the flat line. And now all of a sudden we have the second wave that's been talked about throughout the media and other, people, health commentators and stuff talking about the fact that there would probably be some sort of second wave once we reopened the economies and people came out of lockdown and started interacting again and so forth. And so it looks to me like, yeah, we're getting that in spades. And I don't want to say that's a parabolic move, but that's a pretty sharp up move in the rate of change of the cases. And that is a concern. It's a big concern. And I think the authorities here in Australia are concerned. And if I just go back to the main menu here of the Sydney Morning Herald webpage, there's all sorts of stuff going on here. People are still traveling, and despite roadblocks and stuff, somehow these idiots are getting through. And and here's this guy testing positive who's driven all the way up from Victoria to Sydney. And you just think to yourself, seriously, people, what are you doing? Anyway, I think that, and again, here we are with Victoria recording a whole raft of new cases. So it's this COVID situation for me, and I'm not a health professional, but I'm not concerned about getting it because I don't think I'm going to die because I'm a healthy human being. I'm sure it would be uncomfortable and my body would have to deal with it. But the reality is that the disease, the virus rather, still seems to only be affecting really badly, as in causing them to die, people who are already sick, or particularly the really old and the elderly who may already have weak immune systems or compromised health situation as it is. So I don't fall in that category. Most of my clients, as far as I'm aware, don't fall in that category. So I don't think I'm worried per se about the actual virus. What I'm more worried about is the way the authorities react to the virus and how they, intend to control a second wave, meaning what is the economic fallout going to be? And this is, the subject of my concern around the COVID resurgence is what's it going to do to, and we're not in a recovery, but what is it, how is it going to affect and even postpone an economic recovery? And what's it going to do in the meantime, right? So anyway, that's COVID. One of the other things, quickly, just to sprinkle in some geopolitics that I think is interesting. I don't know if it's here on the Sydney Morning Herald. Let me just pop over here to the CNBC site. You probably have, if you're watching any news at all, you would know that China and the U.S., China and India, China and Australia, China and other parts of the world, there is friction going on between China and a number of allies of Australia, including Australia. And this is very interesting because China, I've talked about China in other updates. China is actually, interestingly enough, in a bit of an economic quad one right now. They're in a bit of a recovery. Now, how long that lasts and whether it's manufactured and all the rest of it, I don't know. But it's very interesting right now that China seems to be on the outer with a number of countries. They're being called out for trade practices. They're being called out for their political, how they try to influence countries politically. Obviously, they are in a shooting, I don't want to say it's a war, but some sort of skirmish with India at the moment. And obviously, there's Hong Kong flaring up, that whole thing going on there. So they're under the spotlight. They're under some pressure. And it's interesting that the Chinese stock market in particular has been ramping up. And that's what I had on this screen just a moment ago, and I'll come back to it. This is a chart of the Shanghai composite. We've seen the Shanghai being very subdued and really in a bear market for the better part of the last, I don't know, probably 3 to 4 years. Sorry, there's a lot of crap on this chart here. And then all of a sudden, we've got in the last probably week to 2 weeks, we've got this ramp in the Chinese stock market. Very interesting that this has happened. They are a command economy. And what that means is they can influence a lot of things very quickly in their economy. Now, they can't influence it forever, but they can do things like this. They can take the Shanghai Composite from, I don't know what, probably 3,000, let's say, to 3,400. That's a pretty big move. It's about a 10% move in a very short period of time. They can do that. They can do that in the U.S. as well. The Plunge Protection Team, which I might have mentioned before, they're a government, sort of a non-government body, but everyone knows they exist. And they do get in and influence. I think I talked about it actually on Wednesday. They get in about 2 to 3 in the morning at the moment, and they do things to markets when volume and trading is very thin. They're able to drop, a lot of money into the market and influence futures, the direction of futures, and this sort of thing. Anyway, I'm not going to go into all of that today, but the point I'm trying to make is the governments of the world that can, because they have a printing press or a very powerful central bank, are able to go in and influence financial markets. So just to close off the whole COVID conversation, what I'm curious to see happening now is, or what's going to happen now, is whether or not this causes another economic shutdown. I mean, the U.S. at the moment has got cases it's rampant. And of course, they're going to be reopening Major League Baseball and doing a few other things. So, and it's the middle of summer, people on holidays. It's going to be interesting to see if they get control of that over there. If they do not, I just don't know whether the U.S. might have to shut down again. Anyway, we're still in very uncertain times, and it's one of the main reasons why I keep saying to all of you, my job right at this moment, my job is always to preserve capital and to protect it. But right now, in particular, have no illusions about the fact that we are in a bear market and we are in a very risky market, that risk can appear all at once. And I think we're about to see, possibly in the next couple of days, it could be happening live right now as I'm recording this, that we see the markets which have run pretty fast these last week and a half. Maybe they're rolling over here because we are staring down the barrel of earnings. But first I want to talk about inflation. So I have been talking about inflation, and I have mentioned, I'm just going to try to find quickly some charts. So for those of you who have followed my work and what I do and listened to me for a while, you know that the US dollar is a huge driving force in, well, pretty much anything and everything in financial markets. So the direction of the dollar and the strength of the dollar influences a whole bunch of other stuff. And you would also know that the dollar has an inverse relationship to a number of things. You probably know where I'm going with this, right? So the dollar, as you can see on this chart, sort of peaked in May and has since rolled over. So the dollar has gone from a bull market to it is now in a bear market. And what that means is inflation is going to begin to get priced into markets, because as the dollar falls, you start to see inflationary pressures creeping into markets. So that's why corn and soybeans, I don't have a chart for soybeans, but corn and copper and gold, I don't think I have a chart. No, I don't have a chart of gold here. But gold and all the metals have been performing really well, particularly gold in the last month or month and a half. It's been sniffing out inflation. Again, all of the things like soybeans and corn and wheat and cattle and wood, sugar and coffee and cocoa, they're all starting to price in inflation. And that's sort of evidenced by the fact that the CRB index, which is the Commodity Research Bureau index of 32 commodities, I think, has broken out to the upside and is now in a bull market. So inflation rising and growth falling is stagflation. Yes, you got that correct. It's stagflation. We've been here before a few times. It is a bad place to be globally, and we got to get out of it quick. So you'd rather have just a straight out, sort of deflation depression, which is quad 4, because we know what the response is for that. We know where to put assets and how to invest through that. Quad 3 is much trickier. We also have a playbook for that. It is to buy commodities and gold, stay a bit heavier in cash, in my view, but own things like inflation protected tips. So you'll see this last week or two, I've put on a couple positions in bonds, which actually do that. They've been performing really well. They might be up a bit or down a bit. It's not, bonds are sort of like watching paint dry. They are there to preserve your capital and protect your portfolio from any major volatile swings. But in any case, just to wrap up the inflation thing, we're starting to really see that creep in now. So it's something to be watched, and it will have an impact on markets at some point.
You've been listening to the Money Matters podcast. Thank you for joining us.
Particularly with
if you
bonds,
liked the content that you've heard today, please subscribe to the
at some
channel.
point.
And remember to leave
finally,
a comment,
earnings.
like,
I don't have any
and share
updates
it.
on earnings.
Thank you for joining us. We'll see you next time on the Money Matters podcast.
You're going to start in my updates, see me put up the earnings table that I have in previous updates, showing you what earnings are doing, what companies are reporting. And if there's any big surprises out there, I'll certainly be talking about them in videos and so forth. But one of the things I did want to highlight to everyone again is the fact that we are entering a period. So I'm going to try to keep the bubble up here. We're entering a period where all of the bad shit that's just happened to the economy is going to be reported by companies. It has to be reported by companies. They're required to report this stuff. And there's going to be some big surprises, and we might see them in some of the big tech names. As an example, we might see Amazon or Facebook or Google or Microsoft or Apple even report some pretty, marginal or poor earnings. And this is going to impact the market. Furthermore, I wanted to circle back around to something I talk about all the time now, which is volatility. And hopefully you're getting the point around volatility, which is when the regime of volatility is that there's a lot of volatility and it's high as measured by the volatility indexes of a particular asset class. It is absolutely a sign to either stay away, or so a red light, or it's a green light to say the volatility is low, so you allocate capital to that. I'm going to give you an example of that. I talk about it a lot. You all know the VIX because I talk about it a lot. VIX, there it is on your screen. I'll just pop the chart up. The VIX has been unable to get below 26. So it's tried, there was, it didn't close there, right? So close. It has traded almost below it, but it hasn't closed below it. And that's the key, is you want it to close below that level and then start trending down. It hasn't been able to do that. And in fact, if you look at this chart, it's an 8-hour bar chart, but it's basically a daily chart. You can see where vol, spiked up badly back in early June, around June 8th, which was probably the most recent high in the market. So looking back, we have seen lower highs and lower lows from June 8th. And interestingly, that's when we had a big spike in volatility. And from that point, volatility's dropped back off, but it's been unable to break the back of the 26 mark. And again, we want volatility to sort of be all clear for us to go back into equities, all the way back into equities. We need to see vol get down between let's say below probably 21 or 20. We need to see that VIX index down in that range before we are going to reallocate all of our capital back into equities. Now, another vol measure that I want to just share with you is the VXN for Nancy. And N stands for NASDAQ. So that is the tech index volatility. Now that vol has been rising as well. And it has now popped up above the 30 mark. And around 31, 32 vol on the NASDAQ is a bit of a warning sign as well. So the NASDAQ and the tech index has been ripping. It's been absolutely rip-roaring, and it's looking very, very bubbly. Interestingly, the tech index is heavily weighted to those names I mentioned earlier, and in particular, one of the ETFs, which is the XLK, which is the tech index, 40% of it is two stocks, Amazon and I believe Google. Amazon and Google, I believe, make up 40% of that index. It's scary. If one of those two or both report bad earnings for this quarter, tech is going to get bitch slapped. So, and it may get bitch slapped anyway if some of the others like Facebook or Tesla or one of these other companies, Microsoft, report bad earnings. But certainly if, two or three companies that are heavily weighted in the NASDAQ indexes as well as the XLK report bad earnings, watch out below is all I can say. And the VIX is sniffing that out because volatility is, again, rising. Now, one final volatility index. So all of these, you can see on my thing here, I've got a bunch of indexes. Now, most of these, if not all of them, are volatility indexes. You can see I am a volatility nerd. I am watching the volatility of stuff with great interest because what I have learned is when volatility, and again, I've said it before, assets are cash flows to assets that have falling low or falling volatility. Cash runs away from assets that have high or rising volatility. If you can just ingrain that in your head around volatility, you couple that with what the US dollar is doing, and you can start to actually time markets without, needing to know much else. So I just wanted to highlight gold volatility. So GVZ is actually the gold volatility index. Now, it is below 20. It's been falling, and it is no wonder that gold is doing very well. So this right here where my cursor is, XAU USD, that's XAU is gold. That's the ticker for gold, the spot market for gold. It's around 1800. It's been as high as about 1817. So it's come back a little bit, which is fine. Things tend to go, they run up and then they come back and then they run again and they come back. So that's fine. I haven't been too worried about gold because, again, we've got gold sniffing out inflation and we have low volatility in gold. So it's probably sniffing out, for a lot of people, the safe haven trade as well. So anyway, gold is a core holding. It's you all own gold in your portfolios, so that's good. And gold miners is another one. Now, gold miners are different because they're an equity. So I'm gonna be more concerned about gold, the GDX or miners in Australia, having a risk event, a drawdown, because the volatility index is elevating. So the point of me telling you that is don't be surprised if I take some profits in the GDX position to protect it. I can always buy it back later when the equity volatility drops, provided the gold volatility hasn't risen and the gold price hasn't just shot to the moon. So anyway, as you can see, there's a number of interesting dynamics, and I'm probably rambling a little bit now on all of this only because I want you to understand what I look at every single day the market is trading, and that is, and volatility is a huge part of that. So I think I'll just close it off there. Right now, again, to recap, sorry, I'll pull back to the macro level just to recap. We are probably 2 to 4 weeks away from finding out if we're going to see another market crash. And I'm serious about that because earnings being reported now for this period of time are going to be pretty bad. And the market is not pricing that in. The market has priced in a recovery, and we're nowhere near that yet. In fact, we're probably getting pulled back into a shutdown or something that looks like a shutdown because of the increase in the number of COVID cases and the rate of change of a transmission and people being infected with it. So the point I really want to reinforce here is, again, we're in quad 3. We're probably in deep quad 3, which you might as well be in quad 4. It's stagflationary. It's bad. It's very bad for equities. It's good for bonds or fixed income. It's good for certain things that trade like fixed income. And it's good for gold. And of course, it's good for cash. Now, if we are in deep quad 3, which kind of looks like quad 4, the US dollar is going to strengthen. So we just have a real interesting dynamic, which I'm obviously watching to see how the commodities and the CRB index trade in light of the US dollar. Clearly, the US is trying to weaken the US dollar because it benefits them for trade purposes. So they want a weaker dollar. But because the dollar is the global reserve currency and all the commodities are priced in dollars, if we are seeing a resurgence in inflation, then you're going to see downward pressure on the dollar. Anyway, lots and lots of stuff to think about. Isn't this fun? I love it. It's great. It's a game. That's all this is. It's a game. And finally, I guess in closing, what I'm really working on now is getting the timing of these things right. So it's one thing for me to tell you all this stuff and to sort of acknowledge it. It's another thing to put it into practice to either make money or protect capital. So on that note, I think I will say have a fantastic weekend. I hope you're enjoying this stuff as much as I am. I know many of you are commenting to me that you're learning a lot and you appreciate the updates. I am not fearful at all about anything that's coming down the pike with regard to managing your money. Not fearful about anything, because the warning signs are usually there to do something like go to cash or whatever. And furthermore, if the warning signs are there, I'm also going to know how to position your money and my money to make money in an environment like that. And for me, that's pretty powerful stuff. So have a great weekend. And as always, if you have any questions or you want to chat about any of this stuff, please feel free to give me a call, post a comment in the comment section, or just sit back and have a nice glass of something adult here on the weekend. Looking forward to chatting with all of you soon. See you later.